Hi, today I am going to present about one of the accounting theory, that is positive accounting theory. It also called PAT. The name itself has some confusion in positive accounting theory. A positive accounting theory that explains and predict a particular phenomena. Positive accounting theory seeks to explain and predict accounting practices. It does not seek to prescribe particular action. It's only seek on the predicting the accounting practices, not an action. So, next slide about agency relationship. In agency relationship, PAT focus on relationship between various individuals included in providing resources to an organization. This could be the relationship between the owners as suppliers of equity capital and the managers, or between the managers and the firm debt provider. Many relationships involve the delegation of decision making from one party, that is principal, to another party, that is agent. So, agency relationship is relating between relationship between principal and agent. Next slide about the dramatic representation of agency relationship. In agency relationship, principals delegate to agent, and agent perform some function for the principals. So there are some principal have some principal have bonding, monitoring, residual losses, and agent have some problems like self-interest, incongruences, or that means reduce the performances. Next slide about the two perspectives of positive accounting theory, that is efficiency and optimistic. In efficiency perspective is extra handed perspective, that means fat before, and on other hand optimistic perspective is based on after the fact, like exposed perspective. Efficiency perspective minimize the agency cost of the firm. On other hand, the optimistic perspective negotiates some contractual arrangement of the firm and predicts certain opportunities or opportunistic behaviors. Next slide about various contractual arrangements. There are two contractual arrangements, that are owners or managers contracting arrangement and debt contracting. Owners and managerial contracting include some cost. The cost associated with their own prescribed consumptions, rational economic person consumption, or information related cost like information asymmetry. Next slide about how to reduce or method for reducing this cost, like price protection, monitoring by the owners, bonding by the managers, and some of course like manager may be rewarded like on the basis of fixed or on the basis of result achieved, or either both base combination of two. Next slide about bonus scheme. In bonus scheme where manager receive a bonus, that is try to perform of their organization. It include the rewards to the managers to be included in term of profit from the firm or sale from firm or return on asset or based on market share. On this basis our bonus schemes are issued. And next slide about accounting based bonus plan. In accounting based bonus plan is result of new financial reporting standard may be issued, and any changes in the accounting method used by the organization will not affect the account paid. Next slide about incentive to the manipulate accounting number. Accounting profit might not always provide an unbiased measure for the firm performance of value. Next slide about market-based bonus scheme. This bonus scheme is based on market. The market value of the firm's security and net present value, that related activities are this bonus scheme is based. Next one is another contracting arrangement, that is debt contracting. In debt contracting, when party lend fund to another organization, the recipient of fund might be undertake activity that reduce or even eliminate any livelihood of the fund being repaid. These costs which are related to different behavior of borrowers are referred as PAT as an agency cost of debt. Some of these costs are pay excessive dividend, investment in very high risky projects like some of these costs. And next slide about how to reduce or how to minimize these agency cost of debt contracting. The same like owners managers contracting, price protection contractings like minimizing the interest coverage, dividend coverage or current ratio or net worth. Next slide about the political cost. This cost is the external to the firm. It's not inside the firm, it's outside the firm. These costs like increases the cost associated with the increasing the tax. When the taxes increases, wages claim increases, product by truth. And to reduce the political cost, there should be only one method to adopt is income reduction accounting strategy. In summary, this slide about the PAT summary. PAT, the selection of a particular and alternative accounting method can be explained from either an efficiency perspective or an optimistic perspective. And PAT indicate the use of particular accounting method can have opposite effect. Next slide about accounting policy selection and disclosure. Accounting policies adopted by reporting entity. Next slide about accounting policy choice and creative accounting. It is an optimistic. That's the main thing in this accounting policy choice and creative accounting. Next slide and last and final slide is about some of the criticism of positive accounting theory. Every accounting theory has some criticism. The most famous some of the criticism are the following. It failed to provide prescription and no meaning improving the accounting practices. Next one, it is not a value free but rather value laden. All action is driven by desire to maximum wealth. Next one is issue being addressed have not shown any great development. And last and finally is scientifically framed. So this all about the positive accounting theory. Thank you.